Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Guys, I apologize. The projector is not working, so I'm just waiting for the technician came over and fix it. So just give me a couple of more minutes. All right, so while we're waiting for the technician to fix the projector, could you guys please log on to your Wattle site if you have a laptop or tablet? So basically on the Wattle site, I uploaded a document called Final Exam Detail. So if you could please open up that file, I'll go through some couple of important items with you guys. So you guys managed to locate that file. It's called Final Exam Detail. Just click the Final Exam Detail and download that PDF file. So let's have a look. So basically the exam has 15 minutes reading time and 3 hours writing time. All right, you guys should have plenty of time to finish the exam and should be having plenty of time to check your solution as well. And the exam is closed book. So as I mentioned many times, the only formula you will get is the basic Black-Scholes formula, okay? Then it's up to you to modify the equation to deal with the underlying asset that pays a dividend yield and deal with the underlying asset that's foreign currencies, or sometimes you have to deal with the underlying asset is the futures contract, okay? And the third point says you may only use the non-programmable calculator. So basically, graphics calculator and financial calculator are not allowed. There are 4 main questions in the final exam, and each question is has unequal marks, and each question has multiple parts. Okay, so you have to attempt all of the components in each question. So the final question, question number 4, the question number 4 would say that if you are Finland 2002, you attempt part A. If you are Finland 7041, please attempt the part B. So for the last question, please read the question carefully. Okay? If you are Finland 2002 students, you're supposed to attempt part A. If you are Finland 7041 students, you attempt part B. All right? So there's some difference between the 2 questions. There's a difference between the final question you'll get. Okay? So Finland 7041 will get a slightly more difficult question because you guys are postgraduate students, and Finland 2002 students get a slightly easier question. Thank you. Yeah, thank you so much. So basically, the image is not projecting to the big screen.
So that you've obviously tried that, have you?
Yeah, I tried that. So you can try it again.
Right, just turn the system off.
Yeah.
Laptop plugged in. So I'll just quickly. Well, you shouldn't have to, but what I probably needed to check, turning it off and on, was when you. So it might have been on this.
Oh, right.
So what you would have done, so they would have had a laptop.
Okay, yeah,
You've
yeah.
come in and pressed PC,
Yeah.
and it will come up here.
Yeah.
It won't come up there
Yeah.
until you press this one.
Oh,
here,
I see.
Center
Yep.
screen.
Awesome. So this is recording at the moment, right?
It would have been recording. Yeah,
Okay.
yeah, it's recording right now.
Oh,
But
good.
Where the
Perfect.
microphone.
Yeah.
All right, guys, so we have the image now. Yeah, so as I mentioned, there are 4 questions in the final exam. And in terms of the last question, question number 4, if you're Finland 2002, attempt part A. If you are Finland 7041, attempt part B, okay? And this exam is a mixture of calculation and theory type questions. And the final exam is worth 60 marks, and it counts 60% of your overall assessments. And as I mentioned earlier, if you do better in your final exam, then this exam would count 85% towards your overall assessments. All right? So if you did better in the mid-semester test, then your mid-semester test would account for 25% of your overall assessments, and this exam would only account for 60%. Does that make sense? All right, and basically the whole course is examinable, except for the part which I mentioned over the weeks, if you still remember. So basically the part I said is not examinable is, if you go back to week 6, so if you go back to week 6 and open up the lecture slide, So remember, the section number 1, assumption about underlying evolution of stock price is not examinable, as I mentioned in week 6. So this whole part is not examinable. And then the distribution of rate of return is not examinable. And section number 4, theory behind Black-Scholes, is not examinable. All right, so those are the components not examinable for the exam, but rest of the material are examinable. So any questions? Any questions about final exam? Now it's a good opportunity to ask me. Anything you want to ask? Yes. So the question number 4 will be slightly more challenging. All right? Any other questions? Any other questions before we move on? And one more thing. So remember what I did back in week 6? So for the week 6 workshop, I did not cover this Black-Scholes calculation question. Rather, I covered the trading strategy. So I've uploaded this additional slide under the week 4 topic tab. So this slide is called week 4 option trading strategy. All right, so I've uploaded that one under the week 4, if you try to locate it. Any other questions before we move on? Yes? No. So option trading strategy, you are not required to draw the payoff diagram, but you need to be able to detail the payoff tables, okay? And also you have to understand what's the net profit after subtracting the premium, the option premium, and you also need to be able to identify what is the break-even range, all right? So that's what we did back in week 4. Remember, so for all of those trading strategies, sorry, not this one, but this one here. So if you click into the trading strategy, so for example, you need to be able to identify what's the break-even point. Not on a diagram, but in words, okay? Provided in the writing format. Tell me what's the break-even range. And also show me what's the net profit after taking into account of the premium, and show me the gross payoff before taking into account of the premium. Does it make sense? Make sense? Any other questions before we move on? All right, just interrupt me. Just interrupt me if you have any question while we're doing some practice questions. So I've uploaded the lecture 12 slide here. Okay, so this is not an indication what will be on the exam, but I'll use those practice questions to go over some of the stuff that we learned, just to quickly recap some of the key knowledge points. Okay, so the first question is about determining the future price. So the question says, the 2-month interest rate in Switzerland and United States are 3% and 8% per annum, with continuously compounding. The spot price of Swiss franc is 65 US cents, and the future price of a contract deliverable in 2 months is 66 US cents. So the question asks you, what arbitrage opportunity does this create? So very straightforward. So in the final exam, I would explicitly tell you whether you are a United States domestic investor or are you a domestic investor in Switzerland, okay? So this question didn't tell you, but in the final exam, if I give you this type of question, I would explicitly tell you, are you domiciled in US or are you domiciled in Switzerland, okay? So in this particular question, we're actually domiciled in Switzerland. So we learned how to determine the future price for the foreign currencies. So basically, you take the spot price, 65 US cents. So the Swiss franc exchange rate is 65 US. So 1 Swiss franc exchange for 65 US cents. You take the spot price, you bring forward, but remember to subtract the foreign risk-free rate from your domestic rate. So remember to subtract 3% from the 8%. And you bring forward 2 months, and you get a future price is 65 cents, roughly around 65 cents. But remember, the quoted future price given in this question is 66 cents. So clearly this is overpriced, right? So you can do something today to arbitrage away the price difference. Now, basically what we're going to do is we're going to short the Swiss franc futures contract because it's overpriced, and we're going to borrow money to buy the underlying asset, which is Swiss franc. And by doing so, we can lock in a profit of 0.0046. Okay? I feel like this is a good opportunity for me to go over some of the stuff in week 2. So if you go back to week 2, remember how we derived our pricing formula. So just let me go back to this one here. Okay, remember how we derived this pricing formula. So basically we argued that we can synthetically replicate the purpose of a future contract by a strategy called borrowing and buying, right? So if you want to lock in a price to buy in a stock in 3 months' time, for example, what you could have done without the futures contract is by basically borrowing the amount of some amount of money from the bank, which is precisely equal to the spot price of the underlying assets. So what you're going to do today, you're going to borrow S0 amount of money from the bank, and you're just going to buy the stock today, all right? So you buy the stock today, and you hold on to that stock for 3 months until month number 3. So that's the equivalent of buying a future contract, loaning a future contract that would deliver the stock in 3 months' time. So they are equivalent. So basically the argument goes like this. I borrow S0 amount of money, and I buy the stock at S0 price today, and by holding on to the stock, I also entitled to the dividends, right? Because the stock pays a dividend yield. So once I receive the dividends, I can use that money to help me reduce the interest payments that I need to repay to the bank. Remember, in month number 3, not only you need to repay the loan, but also you also need to repay any interest that accrue to the loan. So that's why in month 3, not only you need to return S0, but also S0 times the E to the power of R. But because we're holding to the stock, we're entitled to the dividends, so that dividends help us to reduce the cost of borrowing. So that's why there is R minus D, and bring forward by the capital T here. And that gives us the future price. Remember, that's how we derived the future price formula back in week 2. Now, similarly, if the underlying asset, for example, is crude oil, right? So if you borrow some money today, you buy the crude oil today, and not only you cannot get a dividend yield, but also you need to pay out a storage cost, right? You need to pay out storage cost to the warehouse to keep your crude oil. So if that's the case, if the storage cost is U, now we're going to have S0 times E to the power of R plus U, then times the T, right? Bring forward. So that's how we determine the pricing formula for the futures contract written on the asset where you need to pay the storage cost. Does that make sense? So just some quick recap of how we derived the pricing formula. Okay, so let's have a look at this one here. So this one, we've done this one back in week 2's workshop. So the question says, a stock is expected to pay a dividend of $1 per share in 2 months' time, and the second dividend in 5 months' time, the stock price, the current stock price is $50. Risk-free rate is 8% with continuously compounding for all maturities. The investor just take a short position in the 6 months forward contract on the stock. So what are forward price and the initial value of this forward contract? We know how to determine the forward price, but before we do that, we need to get a clean stock price today, right? The stock price without the dividends. So remember, in this question, instead of paying us the dividend yield, the stock actually pays us the cash dividends, right? So the first thing you have to do is to discounting those cash dividends back to the present and subtract the dividend from the current share price to get a clean share price, and then use that share price to determine the future price. All right, so that's the step. Okay, so the first step is we're going to discount the two dividends back to the present. So the first dividend will be paid in month 2, and the risk-free rate is 8%. So we're discounting that $1 back 2 months' time. And the second dividend will be paid in month number 5, okay? So we're discounting the second dividends back to the present, we're discounting back 5 months. And that's the sum of the present value of the dividends. Then what we did is we subtract the dividend from the current share price, and then we bring forward 6 months, right? We bring forward 6 months, then we get the future price is around $50. So what's the initial value for this forward contract when this contract just initiated? What should be the initial value of this contract? 0, right? So when a future contract just initiated, the initial value is 0. There's no value because anybody can enter into this forward contract at no cost. So the initial value should always be 0. So the second part says 3 months later, the price of the stock is 48, and risk-free rate of interest still 8%. What are the forward price and the value of the short position in the forward contract? Okay, so instead of focus on this blue timeline here, we're going to focus on this purple timeline. So basically, fast forward 3 months, we're standing here, right? So this is our present, and we look ahead. So because 3 months later, the first dividend has already been paid, right? There's only the second dividend left to be paid in month number 5, which is 2 months away from today. So that's why we still need to discount that cash dividend back to the present. We're discounting back 2 months. So we're discounting that $1 back 2 months. We get the present value of the second dividend and remove that dividend from the updated share price, 48. Okay, then you bring forward 3 months. You get an updated future price, which is $47.96. Okay? Then we need to determine what's the value of this forward contract. So remember, you're locking to sell at a higher price, right? So 3 months earlier, you're locking to sell at $50. So if somebody else want to enter into that forward contract 3 months later, they're locking to sell at a much lower price, $47.96. So obviously, holding a contract allows you to sell at a higher price, give you value, positive value, right? So let's compare the cash flow difference in the maturity. So we compare the cash flow difference between 50 and 47.96. Then that's a positive cash flow difference because we value it today. So we discount it back 3 months. We get the present value of this forward contract. So that's how we value this forward contract 3 months later. I think this question is quite straightforward. Any other questions with this one? Okay, so this question says, the 1st July, an investor holds 50,000 shares of certain stock, and the market price is $30 per share. The investor is interested in hedging against the movement in the market over next month and decide to use September mini S&P 500 future contract. The index is currently 1500, and the one contract is for delivery of 50 times the index. So basically 1 point is for $50. So that's the multiplier. And we're also told the beta of this individual stock is 1.3. So basically, having a beta of 1.3 means that your stock is more sensitive than the aggregate market, right? So if market increased by 1%, your stock increased by 1.3%. So it's more sensitive to the market. In other words, we need more contract to hedge our exposure. So remember, this is the equation you learned back in week 2. So basically, the way how it works is that we need to figure out what is the numerator, what is the amount to be hedged. So the amount to be hedged is we're holding 50,000 shares, right? And each share is valued at $30. So 50,000 times 30, that is the amount to be hedged, all right? Then we need to figure out what's the denominator. How much is per contract covering, okay? So each contract is covering 1,500 points, right? And each point is multiplied by $50. So that's how much one contract is covering. Then you're using the total exposure divided by how much per contract is covering, you get a number of contracts. But hang on a sec, because this stock has much higher sensitivity compared to the market. So we need more contract. How many more? That amount needs to be scaled by the beta. The beta is 1.3, so it turns out we need 26 contracts. Okay? So what we're worried about in this case? We're worried about the market will decline, right? So you ask yourself, if market will be declining, what kind of position would protect me from a market declining? What kind of position makes me money when market declining? Come on, this is week 12. What kind of position allows you to make money in a declining market? Short, right? So remember the slope of the short future or forward contract, you make money when the market is declining. So we're going to short 26 futures contract to fully hedge our position. Any question with question number 3? Okay. So question number 4 says the standard deviation of a monthly change in the spot price of live cattle is 1.2, and the standard deviation of monthly change in the futures price of live cattle for the closest contract is 1.4. The correlation between the futures price change and the spot price change is 70%. Now it's 15th of October. A beef producer is committed to produce 200,000 kilograms of live cattle on November 2015. 15th of November. The producer wants to use December live cattle futures contract to hedge its risk. Each contract is for delivery of 40,000 kilograms of cattle. So what strategy the beef producer should follow? So basically, the beef producer wants to hedge the exposure to the live cattle, right? But we don't have a future contract written on live cattle. Rather, we have a futures contract that's correlated with live cattle. So that's what I meant by the closest contract has the standard deviation of 1.4. Now, in that case, we need to figure out what is the optimal hedging ratio. Remember, that's what we learned back in week 2. So this is the formula for the optimal hedging ratio. All right, so basically, is the standard deviation of the spot price divided by the standard deviation of the futures price, then scaled by the correlation between them, right? So we were told the standard deviation on the changes of spot price is 1.2, and the standard deviation on the changes of futures price is 1.4. Correlation between them is 70%. So that gives me an optimal hedging ratio 0.6. Okay? Then having this optimal hedging ratio, we repeat the step that we have done from the previous slides, which is how much exposure we have. So the total exposure we have is 200,000 kilograms, right? And then how much is per contract covering? So each contract is covering 40,000. Okay? So total exposure divided by how much per contract is covering give you a number of contracts. But then we need the number of contracts that's slightly less than that because the optimal hedging ratio is 0.6, right? So 0.6 multiplied on that, we need to loan 3 contracts. Okay? So that's just an application of the optimal hedging ratio. Any question with this one? Okay, so question number 5. You've done this in your TUT question. So basically, we need to design an interest rate swap on an investment rather than liability. Okay? So the question says the company X and the company Y have been offered the following rates per annum on a $5 million 10-year investment. Right? So basically, the way you read this table is that company X, the highest possible rate of return for the fixed rate company X can possibly get is 8% per annum, and the highest possible floating rate of return company X is able to get is LIBOR rate. Right? So this is how you read this table here. What company X really wants is a fixed rate of return, and what company Y really wants is a floating rate of return. So the question says, design a swap that would net bank as the intermediary 20 basis points commission, and then would appear equally attractive to company X and Y. You've done this in your Miss-Mercer test, right? So basically, the first step is to analyze the comparative advantage of company X and company Y. So basically, what we realize here is that company Y has a comparative advantage in the fixed rate of return, right? Because company Y's fixed rate of return is 0.8% higher compared to X investments. And company X and company Y has same rate of return from the floating investments. So there's no difference there. So if you work out the difference in the difference, it turns out to be 80 basis points. Okay, so that's how much we can play around with. But remember to subtract 20 basis point commission for the bank. So after subtracting the 20 basis points, we're left with 60 basis points to allocate to company X and Y. So because the question says we need to design a swap that's equally attractive, so basically company X and Y share the game equally, right? So the 60% divided by 2, so 30 basis points goes to company X and 30 basis points goes to company Y. So the way how this swap works is that although company X wants the fixed rate of return, we still ask X to invest in a floating investment vehicle so that company X can earn the floating rate of return, even though company Y wants the floating rate of return. We would still ask company Y to invest $5 million in a fixed investment vehicle. Okay, so that fixed investment vehicle would provide 8.8% return to company Y. So as I mentioned in the lecture, the way we design a swap is always passing the floating rate all the way across, and then we manipulate the fixed rate of return, right? So that's what we did here. So company X received the LIBOR rate of return from his floating investment vehicle and passing the LIBOR rate all the way to company Y. Okay? Then company Y received 8.8 from his fixed investment vehicle. Then company Y don't need to pay out the full amount, right? Because the company Y needs to share 30 basis points gain from the swap. So we deduct 30 basis points from 8.8. So company Y pays 8.5 to the swap bank, and then swap bank take 20 basis point cuts and passing the remaining to company X. Okay? So basically, the LIBOR just cancel out. So 88.3 points is 30 basis points higher than 8%, right? So 8% is the highest possible rate that X can get by himself. Now, by entering into the swap, X is better off by 30 basis points. So does Y, right? Because Y gets retained that 30 basis points from the 8.8 rate of return he received from the fixed investment vehicle. So basically, company Y is receiving the LIBOR plus 30 basis points, which is 30 basis points higher than the highest possible floating rate the Y can ever get by himself. So by entering into this swap, company X and company Y are both better off by 30 basis points. So any question on this one? Okay, so this question is taken from 2012 final exam. Okay, so the question says, you work for a company and your supervisor Max would like to test your knowledge of swaps. So giving you following information and ask you to set up a swap which would net the GW company who acting as the intermediary 23 basis points per annum. So first of all, we have a company called JR. So JR wants to borrow euros of a floating rate of interest. And then we have the second company called Hedge. So Hedge wants to borrow Japanese yen at a fixed rate of interest. And after accounting for 23 basis points for the intermediary, which is GW, 60% of the gain needs to go to JR, and 40% of the gain goes to Hedge. So what you were asked to do is you need to draw a diagram to illustrate all the cash flow, to illustrate all the rate of interest, and also that you need to show that the JR receives 60% of the gain and Hedge receive remaining 40% of the gain. Okay, so basically this is not so different from our conventional question. We still analyze the comparative advantage between JR and Hedge. So first of all, let's have a look from the Japanese rate of return market. The JR has a lower cost of borrowing, right? JR has a lower cost of borrowing in the Japanese market, 2%. So that's 4% lower than Hedge. And then JR also has a lower cost of borrowing in the euro, right? So JR's cost of borrowing in the euro market is LIBOR plus 1. On the other hand, the HH has a LIBOR plus 3.77%. But the difference is smaller in the euro floating market. So basically, HH has a comparative advantage in the euro floating market, whereas the JR has a comparative advantage in the yen fixed market, right? So you work out, again, you still work out the difference in the difference. So the difference in the difference between the two rates is 1.23%. Remember, we need to net GW, who is the intermediary, we need to net GW 23 basis points as the commission. So that's 1.23 minus 0.23%. So we're left precisely with 1% to play around with. Okay? Remember, this time we're not designing a swap equally attractive to two parties. Rather, JR needs to receive a larger share of the gain, which is 60%. So JR needs to receive 60 basis point gain, and HH needs to receive 40 basis point gain. Okay, so in this question, what we were told is that JR really want to borrow euro floating rate. But based on our analysis, JR's comparative advantage lies in the Japanese fixed rate, because the cost of borrowing in the Japanese fixed rate for JR is really, really low. So we tell JR, still go to the Japanese fixed market and borrow $10 million from your Japanese fixed rate of interest. So basically, JR is paying the Japanese bank 2% fixed rate on the $10 million that JR borrowed. Although HH wants to borrow the Japanese fixed rate, but we analyzed that HH comparative advantage lies in euro floating, right? So we still ask HH to borrow money from euro floating. So the cost of borrowing for HH in euro floating is LIBOR plus 3.77%. So HH take out $10 million loan and paying the euro bank LIBOR plus 3.77%. Okay? So basically, what JR really want to pay is the euro floating, right? So now we tell JR, yes, you can start to pay us the euro floating. So that euro floating has to precisely cover the cost of borrowing for HH. So again, we're passing the floating rate all the way across to HH to repay HH's euro floating borrowing. Okay, so that covers HH LIBOR plus 3.77%. Now, what HH really want to repay is the Japanese fixed rate. Now we'll tell HH you can pay that. Okay, so HH pays, how much HH needs to pay? Remember, HH needs to receive 40% of the gain, so HH needs to be better off 40 basis points. So the current best possible rate HH can get by himself is 6%. Now we need to improve his life by 40 basis points. So that's 6% minus 40 basis points. So all HH needs to pay us is 5.6. So 6% minus 40 basis points. So HH just need to pay us 5.6%. And then we take 0.23% cut. We're passing the remaining to JR. Right? Then we complete the swap. So if you analyze that, you realize that the JR is better off by 60 basis points and HH is better off by 40 basis points. So the total gain is 1%. Any question with this one here? So because the principal are both 10 million US dollar loan, right? So it's not so different from the conventional swap that we designed. Even though the fixed rate is in the Japanese market, even though the floating rate is in the euro market. But the mechanics is identical to what we have done back in week 3. Any question with this one? Okay, so let's have a look at question number 7 then. So this question says a European call option and a put option on a stock both have strike price of 20 and both have expiration date in 3 months' time. So both options are selling for $3. Risk-free rate is 10% per annum. The current stock price is 19, and $1 dividends is expected in 1 month's time. How can we identify an arbitrage opportunity here? How can we identify an arbitrage opportunity here? What do you reckon? Poco parity, right? Because the hint is given in the question. So they both have the same strike price and both have same maturity, right? And now we have a call, we have a put. So this is the best scenario for us to use the Poco parity. Okay, so this is your Poco parity formula. But one thing we have to take care of is the cash dividends, right? Because this time the underlying stock pays $1 cash dividends. So all we have to do is to subtract the cash dividend from the current share price. So basically, this is just your Poco parity formula, subtracting the dividends from the stock price. So basically, we were told the call option is selling for $3. Strike price is 20, so this is the present value of the strike. And put option is also selling for $3. So the current share price is 19, so 19 minus the present value of the dividends. So you realize the left-hand side does not equal to the right-hand side. Right? So you work out the left-hand side is higher than the right-hand side. So how can we set up an arbitrage strategy today to explore the price difference? So basically, we're going to sell the entire left-hand side because the entire left-hand side is higher than the right-hand side. So what we do is we're going to short the entire left-hand side, and we're going to take a long position in the right-hand side. Okay? So what do I mean by that? Short the left-hand side simply means you're going to short a call option. Okay, so you sell a call, you receive $3 today. And how do you short
a zero coupon bonds. Shorting the zero coupon bond simply means borrowing the present value of the X. Okay, so the present value of the $20 is 19.5. So we're going to borrow this much today. And then we're going to take a long position in the right-hand side. Okay, so long position simply means we're going to buy the put. We spend $3 to buy the puts, and then we buy the underlying stock at $19. So if you do this correctly, you're going to get 50 cents arbitrage profit today, and then you're also going to get $1 dividends. Okay? So buy low, sell high. That's the key essence behind arbitrage strategy. Yes, so basically in the final exam question, I'll be more clear with that. So I'll ask you how much exactly is the arbitrage profit? Yes, you need to detail all of the position here. Yeah. Any other question with this one here? Any other question with question number 7? Okay, so let's have a look at question number 8 then. So question number 8 says, a stock price is currently 40, and it's known that at the end of 1 month, it would either be $42 or $38. The risk-free rate is 8% with continuous compounding. What is the value of this 1 month European call option with a strike price of 39? So this is just a one-step tree. We know how to do that. So you take the current share price, and we were told it would either increase to 42 or it would decrease to 38, right? And we're holding an option with a strike price of 39. So 1 month later, if the share price end up with 42, that's $3 in the money. So that's basically 42 minus 39, right? So the call option has a payoff of $3. Now, if the share price decreases to 38, so that's $1 below the strike price, which means the call option is out of money, right? So it has value of nothing. So it's very straightforward, just one-step tree. And all we need to do is so first of all, work out the proportional increase and the proportional decrease. Work out U and D. So basically, we'll take the ending price divided by the initial price. So that's the proportional increase. Again, you repeat the same process. You take the ending price divided by the initial price. You work out the proportional decrease. Then you have all the information to work out your risk-neutral probability, which is P star. So we were told the risk-free rate is 8%, and the delta T is simply 1 month. So that minus D divided by U minus D. So we get the probability of going up and the probability of going down. Then one last step is simply discounting this expect payoff back to the present, discounting back 1 month. So if the share price go up to 42, then we get a payoff of $3. If it go down to 38, this call option finished out of money, right? Then you discount it back 1 month. The call option price is $1.69. So this is risk-neutral pricing. Remember, we also covered replication approach. We also covered delta hedging approach. Okay, so you need to know all three approaches, not just the risk-neutral, but also replication, as well as the delta hedging approach. Okay, so that's written in week 5 lecture slides. Go home, revise that yourself. So any question with question number 8? Any questions with question number 8? Okay, so question number 9 says, you're given following information. The price of a non-dividend paying stock is currently 69. and the strike price of a European put option is $70. The risk-free rate is 5%. The volatility of the stock 35%. Time to maturity of the put is 6 months. So what is the price of this European put option? So this is the straight up application of your Black-Scholes formula, right? First of all, this is a European option. We can use Black-Scholes, and we're given the volatility, we're given the time to maturity. So the first step is always do your preliminary calculation. Calculate your D1 and D2 first. All right, so we're given the spot price, we're given the strike price 70, and risk-free rate is 5%. The volatility is 35, so the variance is 35 squared divided by 2, then times 6 over 12. So the denominator is simply the volatility times the square root of time t. Okay, so round up to 2 decimal places. Okay, so when you calculate D2, when you're doing this sequential step, using as many decimal places as possible here, so we calculate D2 is equal to negative 0.08. Remember, we're dealing with the put option here, okay? So this is what the put option formula looks like. What we try to find is n minus D1 and n minus D2. So we work out D1 is 0.17, right? So minus D1 is simply minus 0.17, and given the D2 is minus 0.08, so we try to find n minus D2 here. So minus D2 is positive 0.08. So again, as usual, you go to your table, you find corresponding probability with minus D1 and minus D2. And the last step is simply plug into your put option formula. So with the put option formula, that's the present value of the strike times n minus D2, then minus the spot price times the n minus D1. So you get the put option price $6.47. So remember, if you're getting a question that pays the dividend yield, remember to subtract the dividend yield here and also do some modification with the spot price. Okay, so if you're given with the option written on the futures contract, there is no risk-free here. Okay, so remember how to modify the D1 formula when you're dealing with the option written with different underlying assets. Okay, again, this is another Black-Scholes application, but this time we try to work out this option price written on an index. So the index currently has 696 points, volatility is 30%, risk-free rate 7%, and the dividend yield is 4% per annum. Okay, so we were told strike price is 700 points. They are not dollar, but they are points. So again, you plug everything into the D1 and D2 formula. Sorry, I should have written R minus Q. So remember to subtract the dividend yield from the risk-free rate. Again, you work out your D1, D2, then you go to your table, find the corresponding probability for n minus D1 and n minus D2. So another modification is that you have to strip away the dividend yield from the current spot price. So that's S0 times the E to the power of minus QT. Okay? And then you work out the put option. But the put option price should always be expressed in a dollar term. Remember, if I didn't tell you what the multiplier is in the question, you automatically assume the multiplier should be $25. Okay, so that's 40.56 points times $25. So this is how much the put option should be selling for. So any other question with question number 10? Okay, question 11. Question 11 is the call option written on the futures contract. So question 11 says, suppose that you sell a call option on April live cattle futures contract with a strike price of 70 cents per pound, and each contract is for delivery of 40,000 pounds. So what happens if the option holder exercises this contract when the future price is 75 cents? So this is the question you got for your quiz number 4. So basically what we did here is we write a call option, we sold a call option that written on the futures contract, okay? And the strike price is 70 cents per pound for 40,000 pounds. So if the option holder exercises this call option, what would happen to you as the call option writer is you get into a short position in the live cattle futures contract, all right? You get into a short position in the live cattle futures contract with a delivery price of 70 cents. So that's your strike price. And remember, the option holder would also get paid a cash amount. So option holder will be paid FT minus X. So FT is the future price on the day the option holder exercised, right? So on the day the option holder exercised is 75 cents. And the strike price is 70 cents. So if the option holder gets paid 75 minus 70, then you lose that much, right? Because you're short this call option. So that's why there's a negative sign in front of that. So as the call option writer will lose this much, and because each contract is for delivery of 40,000 pounds, so this is multiplied by 40,000, so you need to pay out $2,000. Okay, which means $2,000 is subtracted from your margin account. Right, so you've done this in your quiz number 4. By the way, I will upload all of the quiz mark by end of this week or early next week. Please make sure go to your Wordle, check your quiz mark is properly entered. If you have, if it's not entered, then email me. I'll fix that. Okay. So any question with question 11 before we move on? Okay, so question 12. So question 12 says the futures price is currently 60, and it is known that over each of next 2-3 months period, it would either increase by 10% or fall by 10%. The risk-free rate of interest is 8%. What is the value of the 6 months European call option on the futures with a strike price of 60? So this is the question we need to use the binomial option pricing, right? So first of all, work out your proportional increase and proportional decrease. So we were told the price would either increase up by 10% or decrease by 10%, right? So the little u is simply 1 plus the 10%, so that's 1.1. And the proportional decrease, the little d is simply 1 minus 0.1, so that's 0.9. So once we have the proportional increase and decrease, we are able to draw the binomial tree. So we simply take the current future price, $60, then we multiply by 1.1, we get 66 here. Then we take the current future price, $60, we multiply by 0.9, and we get a future price down here, 54. So basically, you repeat the same process, you complete the binomial tree. And what else we were told? We were told strike price is also 60. So if the future price finished at $72.60, so our call option is $12.60 in the money, okay? And if the future price finish in the middle, 59.4, the call option is out of money, and the same thing goes to here. If the future price finish at 48.60 cents, so that's lower than the strike price, again, we have out of money call option here. Because this is a European option, we can discounting the expected payoff all the way back 6 months, right? The other thing we need to do is to calculate your risk-neutral probability. So remember, we're dealing with the option written on the futures contract. So the equation here is very concise. It's simply 1 minus d divided by u minus d, and that gives you the risk-neutral probability. So you work out the risk-neutral probability is 50%. And then the last step is simply discounting the expected payoff of the option all the way back 6 months. So you get the European coal futures option is $3, right? Roughly around $3. Now, if this is the American put option, you have to work at each branch of the tree, right? So we've done this many times. Any question with question number? Yes? Sorry? Yeah, so, okay. So basically, I talked about this in week number 8. Just let me show you this slide here. So that's the way we derive this equation here. Okay, remember, as I mentioned earlier, if you're holding the futures contract, what happened to you is that you have a margin account, right? And the cash balance in your margin account is earning the risk-free rate every day, every single day. So that's the equivalent of holding an asset that providing an income yield equal to the risk-free R. So remember, we also removed the income yield from the risk-free rate. And it just so happened that income yield also equal to the risk-free rate. So we have the exponential to the power of R minus R. So that gives us power of 0. So e to the power of 0 simply equal to 1. All right, so that this equation just reduced to, in the numerator, 1 minus d, and in the denominator is u minus d. So this equation was not given to you. You have to remember this. Any other question relates to question 12? So basically, the only formula you will get in the exam is this one here. So go to your Wordle side. So that's the only formula you will get. It's this one, right? So any other question before we move on? Okay, so question number 13 is very similar to your quiz number 5. So the question says, what does it mean to assert that the delta of a call option is 0.7? And how can a short position in 1,000 options to be made delta neutral when the delta of each option is 0.7? Okay, so first of all, how do we interpret delta? As I mentioned before, the delta tells you the changes in the option price with respect to the changes in the underlying assets price. So that simply means if the stock price changed by a small amount, then the option price changed by approximately 70% of that. Okay, so let me ask you, what are some of the problems you encountered when using the delta hedging? Do you guys still remember what are some of the problems you encountered when using delta hedging? Give me some of the problems. What's the first problem? Remember, delta hedging is not perfect. There are some issues with delta hedging. Time consuming because each time when the stock price changes, the delta changes accordingly, right? Now you have to rebalance your position in your portfolio to keep your delta still remain neutral, right? To keep your overall delta still 0. It takes time to monitor the stock price, and it costs you money to trade the underlying stock. That incurs the transaction cost. What else? What are some of the problems when you're using the delta hedging approach? That's just one point. What else? So what does this graph tell you? What does this graph tell you? Remember how we get delta. The way we get delta is by taking the first derivative of the option price with respect to the share price. Right? So what does this mean? So remember, the option price and the stock price has a positive correlation. But this positive correlation is a nonlinear positive correlation, right? So why is nonlinear? Because when the stock price becomes higher and higher, as the option becomes more deeply in the money, then the option price is more sensitive to the changes in the share price. So that's why if you take another tangent here, the slope on that tangent line will be much higher compared to the slope of this tangent line. Now, if the stock price is really low, that means the option is out of money. Now, if the option is out of money, that means the option price is less sensitive to the changes in the underlying share price. So that's why when I take another tangent here, you realize the slope on that tangent line is actually lower compared to this one here. So that implies the delta only works for a small changes in the share price, right? So let's say if the share price changed from this point A to point C here, then our linear approximation still works well. However, if the share price changed by a larger amount, changed from point A to point D, then look, this part of the curvature is not captured by our linear tangent line. So that means the delta only works for a small change in the share price. Okay? So basically, I detailed all the issues that I encountered using delta hedging. So as I mentioned earlier, the large movement in the share price, then the delta would change accordingly. So you have to constantly readjust your position in the underlying asset to remain delta neutral, which means the sum of the delta equal to 0. And this process is time consuming and incurs transaction costs. Okay? So that's what I mentioned. Now let's go back to the question. So basically, we short call options, right? So if you short call option, what kind of delta are you getting? Are you getting positive delta or negative delta? Remember, call option has positive correlation with the underlying share price, right? So that's if you take a long position in the call option, as the share price become higher, the payoff on your call option become higher as well, right? Now, if you short call option, of course, it's the opposite. You get a negative delta, right? As the share price becomes higher, you have a much larger loss, because if the option holder exercises the option, then you lose money. So that's the negative correlation going on there. Now, if I short 1,000 options, which means I'm getting negative delta on those options that I shorted. So how much negative delta? 0.7 times 1,000. So negative 700 deltas from the short calls. So how can I neutralize my position in the short calls? I need to find positive delta, right? So the underlying asset always gives us delta of positive 1, remember? So in that case, we need to buy 700 shares to neutralize negative 700 delta exposure we have in the short call. Does it make sense? If you take a long position in the puts, what kind of delta are you getting at? You're getting positive or negative? Take a long position in the put. Sorry, if you take a long position in the put. If you take a long position in the put, you're getting positive or negative? Come on, guys, this is week 12. You take a long position in the put, you're getting negative delta, of course. What about shorting the put? Shorting the put, you're getting positive delta, right? Okay, just go home and revise that. Question 14, calculate delta of at-money 6 months European call option on a non-dividend paying stock when the risk-free rate is 10% and the stock price volatility is 25. Okay, so go back to that slide in case you forgot. Now, if you take the first derivative of the call option price with respect to the share price, the delta you're getting is in fact ND1, right? So if you do the derivation properly, what you will get is ND1. So ND1 give you the delta on the long call option, okay? Now, this question says, calculate the delta on the at-money 6 months European call option. Okay, so which means at-money, which means the spot price equal to the strike price, right? And then we were told the risk-free rate is 10%, standard deviation is 25%, time to maturity is 6 months, 6/12. How can we calculate this? I mean, at-money, of course, if they are the same, then that's the natural log of 1, okay? So you can simply put natural log of 1 here. And so that's risk-free rate is 10%. That's the variance. And times 6/12. So you work out the D1 0.37. Then go to your table. 0.3 is here. And then look across 0.07. So ND1 is 0.6443. Okay, so ND1 is your delta on one call option that you loaned. So if you short a call option, you'll get a negative 0.6443. Does it make sense? Okay, so if you are given the option that's written on the foreign currencies, remember when you calculate your D1, subtract the foreign risk-free rate from the domestic rate, right? So any other question with delta before we move on? Anything you're not sure? Anything you have doubts? You can ask me. Yes. Yes.
This lecture will cover about like
Okay, so he asked a very good question. So week 10, week 12, week 10? You're talking about week 10? Okay, in terms of week 10, in terms of the week 10, what you need to know is similar to the quiz, right? Similar to the quiz you've done last week. You need to know the definition of you need to know the definition of all the exotic options, and you need to know their payoff. But you don't need to know how to price them, right? Because we didn't learn how to price them. We only talk about the payoff of those exotic options. Is that clear? Definition plus the payoff. All of them. Yeah, all of them. That's right, all of them. And then in terms of, let me have a look. In terms of the, you don't need to know anything about mortgage-backed securities. That's not examinable. In terms of the non-standard swap, it's not examinable. Okay? Are we cool? What else? But, sorry, let me go back to the non-standard swap. Remember, we also covered credit default swap last week. That's examinable. Okay? So, the non-standard swap I'm talking about, not examinable, is, for example, this step-up swap, no. Amortizing swap, no. So for those, you need to know, okay? So fixed for fixed currency swap or the floating for floating currency swap, you need to know that because we have just demonstrated one example of that, right? So that's this question here. For LIBOR in arrears, you don't need to know. Constant maturity swap, you don't need to know. Differential swap, you don't need to know, all right? Total return swap, yes, you need to know. Accrued swaps, you don't need to know. Cancelable swap, nope. Commodity swap, nope. Indexed one, nope. Credit default swap, yes. Is that clear? Basically, you need to know credit default swap, total return swap, currency swap, and interest rate swap. Interest rate swap including the one we designed for the liability, the one we designed for the investments. Is that clear? That's clear, right? Yeah, week 11 we've done credit default swap. We need to know that. Total return swap, yes. So in terms of the credit default swap and total return swap, you don't need to know how to design them. But you need to demonstrate in words how they work in practice. Explain their mechanics and motivation why people want to enter into credit default or why people want to enter into the total return swap. I've done that in the workshop. Just go to the workshop slide and revise them. Week 11, what you need to know. As I mentioned, you need to know credit default swap. You need to know the total return swap. Remember the CDS, we've learned two methods of settlements. If the reference entity defaulted on its debt, you can either settle through the physical settlement, which means the seller of the CDS is obligated to buy the face value of the bond from you, right? So that's one way you can settle it. The second way is called cash settlement, which is by organizing an auction and basically you try to find out what's the market value of this troubled bonds. So the market value of that bond simply means how much you can recover from the bonds, right? So that's the recovery rate. Now, once we determine the recovery rate, then the seller needs to compensate the buyer the amount that's remaining. For example, in this question here, we determined the recovery rate is, I remember, 25%. So the recovery rate is the Q. So 1 minus 25%, basically the seller needs to compensate 75% of the notional principal of the corporate bonds. So that's the cash settlement. So that's how much the seller needs to pay the buyer. But remember, all of the payments of the CDS is made in arrears, either in annual arrears or quarterly arrears. In order to get that cash payment from the seller, the buyer also needs to pay any amounts that's accrued on the CDS before the default, right? So we've done that in the workshop as well. Does that make sense? Okay. Total return swap. Yes, basically you need to demonstrate why people want to enter into total return swap and how do they work. Credit spread option, no, you don't need to know that, okay? Weather derivative, yes, you need to understand. So with weather derivative, you need to understand what's HDD, what's CDD, right? So a quick reminder was HDD. HDD captures the heating degree days, right? So the way the HDD work, I think it's a good chance for me to go back to the practice question because I do have one that's written here. Sorry, let me talk about HDD first. Okay, so the payoff of HDD is expressed by this equation here. So first of all, we have an initial temperature, which is 65 Fahrenheit. So this option is traded in the United States, so everything is in Fahrenheit. 65 Fahrenheit is equivalent of 18 degrees Celsius. So why this initial point matters? Because 18 degrees Celsius in a room temperature is quite comfortable. So you don't need to use heater, you don't need to use air conditioning, all right? Now, what's the capital A there? The capital A is the average temperature that you measured over a course of day. So the way how this average temperature works is you get the highest temperature in a day, recording a day, and you take the lowest temperature that you're recording in a day, and you take an average of that. So that's your capital A. So imagine the capital A is 50 Fahrenheit. So 50 Fahrenheit, which is equivalent of 10 degrees Celsius, is quite cold, right? So 65 minus 10, so that's 15. So that means when the temperature is really cold, people want to use their heater, and that would increase the demand on the electricity. So if that happens, 65 minus 50, so that's 15, right? So 15 Fahrenheit. And 15 Fahrenheit is then multiplied by a dollar multiplier. Imagine is 1,000. So as the energy retailer, you will be compensated $15,000 if that happens. Does it make sense? Now, vice versa with the cooling degree days, that means when the temperature is really high, then people need to use their air conditioning. Okay, so imagine this average temperature is 75 Fahrenheit. So 75 minus 65, so that's 10 degree Fahrenheit excessive, right? So 10 degree Fahrenheit is excessive times $1,000, so you get compensated $100,000 if everybody start to use their air conditioning. So there is a high demand in the electricity again. So that's how you remember the payoff from the weather derivative. So those are the daily HDD and the daily CDD. Sometimes the question would give you the cumulative CDD and the cumulative HDD over a course of a month. Then what you need to do is you simply sum up all of the daily HDD to get the cumulative HDD for that month. Okay? If the question gives you the daily CDD, you simply sum them up, you get a cumulative CDD for the month. For example, in this question here, what we were told is that suppose each day during July, remember July has 31 days, the minimum temperature is 68 Fahrenheit, the maximum temperature is 82 Fahrenheit. What is the payoff from a call option that written on the cumulative CDD during July with a strike price of 25 and a payment rate of 5,000 per degree? So 5,000 per degree is your multiplier here, right? Now, the first thing is to work out the capital A. The capital A is the average temperature, right? So the maximum is 82, the minimum is 68. 82 plus 68 divided by 2, so the average is 75 Fahrenheit. And as I mentioned earlier, the 75 is higher than 65, so that's 10 degree excessive, 10 excessive degree. And because there's 31 days in July, so that's 10 degree, that's your daily CDD, multiplied by 31 days, so that the cumulative one is 310. So the cumulative CDD for July is 310, and our strike price is 250, right? So 310 minus 250, then multiplied by the multiplier, you'll be compensated 300,000 by holding this call option. Does it make sense? So any question before we move on? Okay, so what else is in the last week? Let's have a look. So weather derivative, we'll talk about this. Yes, you need to remember what's the energy derivative. All right. So basically, there's two types. This is the off-peak hour. This is the off-peak hour option. So 5 times 8. So basically, that's 5 days in a week, from 11 p.m. to 7 a.m., 8 hours. So that's the off-peak hour. Everybody's sleeping, right? Now, this is the peak hour option, which is 5 times 16, from 7 a.m. to 11 p.m. And again, there's daily version of that, and there's monthly version of that. So basically, daily version of, for example, 5 times 8 simply means at the beginning of each day, beginning of each weekday, you make up your mind whether or not I want to commit myself to buy a certain amount of energy at a strike price. So you lock in the price at the beginning of each day. Now the monthly contract, simply at the beginning of each month, you make up your mind whether or not I want to commit myself to buy this amount of energy specified by the contract at a strike price, right? So obviously the monthly contract will be a lot cheaper because the monthly contract has less flexibility associated with that. Okay, so insurance derivative, the only thing you need to know about insurance derivative is the CAT bond, catastrophic bond. Right, so as I mentioned in the lecture, the way the CAT bond works is that the insurance company would issue a bond, okay? So this bond is called CAT bond. The CAT bond just works like any other bond, ordinary bond. It pays the coupon at the maturity also pays the principal. Okay? Now, if there's a major disaster occur, then the insurance company need to make a lot of damage claim to the household, right? So that's the time when the insurance company start to make a large payout to the household. All right? So as part of the cat bond contract, as the bondholder, you have to give up all of your remaining coupon and principal so that insurance company has enough money to make those damage claim. So that's the difference between ordinary corporate bonds and the cat bonds. Does it make sense? So as I mentioned here, the bond is issued by the insurance company. Now the benefit of cat bond is the cat bond pay a higher than usual coupon rate. Okay, so that's the first thing. And once there's a major disaster occurs, then as the cat bond holder, you need to give up all of your coupon and principal to the insurance company. Okay? Now, what's the benefit of holding the cat bond? Who can tell me what's the benefit of holding the cat bonds in your portfolio, especially you're already holding a well-diversified portfolio? Sorry? It's not so much of a low risk, but rather it's about something else. Remember, risk is expressed in two formats. The first format is the variance, right? Portfolio variance. That's the first format. That's called a total risk. And there's the second component out of the total risk, which is the covariance term, right? So the covariance term is expressed by the beta, systematic risk. Okay? So what's the benefit does the cat bond has that other bond cannot give to you? It's not correlated with any other risky asset in the capital markets, right? Because the occurrence of the disaster is uncorrelated to the performance of the capital markets. Now, the benefit of that, as I mentioned in the lecture, is that if you're holding a well-diversified portfolio, as the number of risky assets that you increase in your portfolio, then that pushes down the total risk to the point there is only systematic risk left, right? And then adding more risky assets on your portfolio will not help you reduce that systematic risk. Why? Because as mentioned earlier, all of the risky assets in the capital market are more or less correlated. Imagine if the financial crisis hit the market, then regardless if stock or corporate bonds, they all decrease in value, right? So that's the risk that cannot be avoided. However, the benefit of cat bond is that the occurrence of disaster is not correlated with other risky assets in the market. So that further reduces this average covariance in your portfolio. That would further push down the systematic risk. So having the cat bond in your portfolio gives you diversification benefits, further reduce the systematic risk from your portfolio. Does it make sense? Okay. What else we'll talk about in week 12? Remember, we talked about this rogue trader, Nick Leeson. So remember, what Nick Leeson did was writing this short straddle strategy on Nikkei 225, right? Who can tell me how does short straddle work? Who can tell me how does the short straddle work? Yes. Exactly. Enter into a short put and short call. So what's the motivation of entering into a short put and short call? To receive the premium today, right? So once you short call and short put, what are you hoping for? You're hoping for the stability, right? Because any large volatility that you're going to incur loss. Because if large volatility would push the spot price away from the strike price, now if the price ends up being really, really high, you're going to lose money on the call that you shorted. If the spot price ends up being really, really low on the left-hand side, you're going to lose money on the put option, right? Because you short a put, remember? Now think about how to modify the short straddle to limit the downside losses that can occur to the short straddle strategy. Think about it.
think about what we have done in week number 4. So go back to week number 4. We've done a couple of trading strategies, so go home, revise them. So that's the long straddle, right? So long straddle, we buy a call, we buy a put, we have a V-shaped payoff. Basically, the way how you work is you would hope for a large volatility in the underlying assets, right? Because large volatility is likely to push the price to be either really high or really low. If that's the case, you're making money on both sides, on both left-hand side as well as the right-hand side. Okay, so that's the long straddle. Now, the maximum you're going to lose is 41 cents, which is the premium that you spend on buying the call and buying the puts, right? So that's the maximum that's going to incur to you. That's maximum loss. Okay, so this is another way you can reduce your loss to the long straddle, which is to go with the long strangle, right? Now, instead of buying the at-money call or at-money put, you're buying out-of-money call and out-of-money put. What that does to your strategy is that would lower the premium that you spend on the option. So that's why we have a flat bottom here instead of a pointy bottom at here. So that further reduces the maximum loss that's going to incur to you. Now the downside is that you would require a much higher volatility from the underlying asset in order for this strategy to make money, right? Because basically you require the asset to have a much larger swing in order to make money. Does it make sense? So go home and think about it. Then we have short butterfly strategy, right? So short butterfly strategies also have this V-shaped pattern. It looks a lot like the long straddle. So go home, have a look how we set it up, the short butterfly. And then we have the short straddle, which is the strategy that Nick Leeson lost 1.3 billion British pounds on the short straddle that he set up on Nikkei 225, right? So why short straddle is so dangerous? Because you're short a call. The danger with shorting the call is that there is no upside limit as to how much the underlying asset price can increase to. Now, if there's no upside ceiling for the underlying asset price to increase to, that means there's no floor for your loss. Your loss is unlimited, right? Because the upside potential for the underlying asset is unlimited, so your downside loss is unlimited because you're short a call. Now, also, if the underlying asset price becomes really, really low, you're going to lose money on the put option that you sold, okay? Now, that's your standard short strategy. Think about how you're going to limit the extreme downside loss that's going to incur to you. Basically, how are you going to limit loss on the two sides? Think about it. Perhaps a long butterfly. Perhaps a long butterfly with the puts, right? Okay, so basically, for the trading strategy, you need to detail a table like this. You need to detail the gross pay, the net pay, and give me the break-even range, okay? Any other question with week 11 material? Okay, one last thing I want to do. Remember back in week 4, the workshop slide? So when I demonstrate the example of the lower bounds violated for the call option and the lower bound violated for the put option, I did an arbitrage strategy look like this, okay? And a lot of people find this confusing. So basically what I've done here is I repeated the same question with alternative solution here, okay? So the difference with alternative solution is we're going to make an arbitrage profit today, and then we leave more potential to make more money if certain things happens, okay? So both solutions are correct, okay? So regardless you use the method I taught in the workshop or the method I detailed here, so both methods are correct. It's up to your preference. Do you want me to go through this again? No? Okay, so everybody understand how to do that, right? So that's the violation of the lower bound for the call option, and that's the violation for the lower bound for the put option. Okay? So basically, you make a positive profit today, and you leave with some potential to make more positive profits at the maturity date. All right, so that's all for the revision lecture. So I've also uploaded a consultation time on the Wordle site. So make sure you check that. So we have 5 consultation time leading up to the exam. So exam is on 18th of June, right? 18th of June. So any other question before? Yes? Why people don't want to access the American call option? Okay, so let's think about. So first of all, let's imagine the strike price is 30. Okay, the strike price is 30, and the current spot price is 70. Okay, current spot price is 70. How much is the payoff of this call option to you right now? 40, right? So it's deep in the money call option, basically. Do you want to access this call option if this call option is the American one? Do you want to access it now? Why? Because access the American call option right now meaning that you're going to pay $30 strike price. Right? So that's a lot of capital you committed to pay. Now, if you're the short-term investor, if you're simply speculating on the spot price, you're better off by selling the call option to somebody else. Selling the call option to somebody else, you'll make same amount of return on the call option premium without paying the strike price. Okay? So that means you don't have to commit so much capital to the stock. So that's the benefit for the short-term investor. Now, the benefit for the long-term investor is that you're going to hold a stock for 20, 30 years in your portfolio. Think about Warren Buffett. They're going to hold stock for a long time, right? Now, it makes no difference to them of exercising the option today to get a stock today or exercise the option at a maturity. Because irrespective of the share price, they're going to hold that stock in their portfolio for a long time. So it's not optimal for the short-term investor to exercise. It's not optimal for the long-term investor to exercise. So in conclusion, it's not optimal to exercise call option early. Okay, go back to week 4 lecture slides. I detailed what I said there. Okay. Any other questions before we finish off here? Or if not, that's all for this semester. Good luck to your exam. Thank you, everyone. Thank you.
For this question, this future price, the delivered price should be
75. Yeah. I made a typo. Yeah. Should be 75 because the strike is 70. Yeah. So I'll correct that. Sorry about that.
Another question is that for delta of the future contract.
Oh, that's not examinable. I forgot to mention. So the delta of the future is not examinable.
Okay.
Yeah.
Okay.
Yeah.
So you asked about how much did you spend on purchasing this. You just thinking about actually pay out for spot price. I don't need to consider the gain or loss future position.
No, you don't need to consider because this one here I ask you what's the effective price. So that's the price you have to consider both. Yeah.
So just spend on purchasing just the money.
Exactly.
The question about this one. Why do we need to use effective rate here?
Because that's per quarter, not per year. So you need to convert into a unit that's expressed per year, right?
But why we don't use the continuous compounding rate?
Then the next step,
Yeah,
it's already continuous, so that's already continuous, right?
no. So if you need to convert it to the effective rate now, it's a 1 plus 2.
Don't worry about this. So in the exam, I would tell you all of them are continuous compounded. Okay, so don't worry about this.
Also, we don't need to convert the.
No, don't worry about it. Yeah.
Yeah, thank you.
Basic question is in y and x.
Why this is just 1 year? So that's basically the difference between y and x, right? So the y in this example, I remember, is 4 year, the x is 3 year. So the difference is 1 year.
Is it necessary for the difference?
Not necessary, but all the example we have done so far is 1 year.
Because if it's not one, the equation.
Yeah, so basically with this question, you don't need to know about discrete forward rate. You need to know the continuous one. So discrete is to illustrate how the continuous one works in a discrete time. Yes, you're right. So if it's more than 1 year, that would be this formula here, but I never taught you guys. So yeah.
So we never to further interest rate.
No, you've already done that for the semester test.
Yeah,
so I
and
decided
it's
final
very
is,
complicated.
yeah, it takes time. It just takes time. Yeah. Okay. No, that's it. I'll be down the front. If you have questions, you can come to the front and ask me, okay? We still have like 15 minutes.
As for we have 6 times 8.
No. There's only 5 times 8 and 5 times 16.
Oh, I see.
Yeah.
Only these 2 times.
Yeah. Basically, you just need to know their definition.
Okay.
Yeah.
And
Yeah, and how they work.
so for the daily exercise, we need to decide whether to exercise at the beginning of each day, right?
Yeah.
Okay.
Yeah.
Thank you so much.
Yeah, so basically depend on the position of the question. So don't worry so much about the sign of the delta. Tell me the position and tell me the quantity of the underlying asset. So basically in the question, I would always ask you what position to take in the underlying asset and how much to take in order to achieve delta neutral. So don't worry so much about the sign that written in a sequential step, but rather give me a quantity of how much of underlying and whether it's long or short. You understand? Yeah. Yeah, so you have to say this is the positive delta, the long call. Yeah, so it's positive delta. Well, if you don't want to say, that's fine, because as I mentioned, I don't really care about the sign. I don't really care about the positive, negative. I only care about the position. So if the question says you're long in the call option, you're long choose on the call in the portfolio, what you need to do to achieve delta neutral? You just need to say a short underlying stock. I wouldn't even look at the sign of the delta you calculated. Does that make sense? Yeah. Because if you're plotting the stock price against the stock price, that's going to be one-to-one exact positive correlation.
So the stock price, $1 increase in the stock price always leads to $1 increase in the stock price itself. So if you measure the sensitivity of the stock price to itself, the delta always come out to be positive 1. So that's why I mentioned in the underlying asset, the delta is always positive. Make sense? Of course. This